Hello and a very warm welcome. You're watching an India Today special broadcast. There is a lockdown in the mutual fund market of a whole different kind. This after Franklin Mutual Funds announced that 6 of their debt funds would be frozen. This is the kind of scenario investors in India haven't had to deal with. There's a lot of concern. At some level, there's a certain amount of panic about possible redemptions increasing Monday morning when the stock markets open. How should retail investors really be looking at what's happening in the debt market? Remember, most of the investments that by and large people who are watching India Today at this time would be making would be in the equity mutual funds route, not the kind of schemes that Franklin Templeton had invested in, but there are lots of concerns. And I hope to build on some of the questions that may have been in your mind and try and take responses from top experts who are tracking this situation very closely. Joining us on this broadcast at this moment, A. Balasubram. He's the Managing Director and Chief Executive Officer of Aditya Birla Sun Life Asset Management Company. Welcome, Mr. Balasubramaniam. Saurabh Nanavati is the Vice Chairperson of the Association of Mutual Funds of India, Chief Executive Officer at Invesco Asset Management Private Limited. Dhirender Kumar is the founder and CEO of one of the top advisory firms for retail investors. And Rahul Goyal joins me as well from Mumbai. He's the Chief Executive Officer of Equity Master, very deeply engaged in giving high quality research-based advice to investors who would be concerned, and therefore we have them to try and give us a sense of what you should be doing at this moment. I want to first explain how these 6 debt schemes run by the Franklin Templeton Mutual Fund Group, which had been giving high returns, came under huge redemption pressure. The managers of these schemes felt that they could not, because of lack of liquidity. Now that there is a massive credit squeeze, the managers said they'll shut the investments down. The money is relatively safe. They'll try and make attempts to redeem the money, but for the moment, it's almost as if these 6 debt funds have also joined the national lockdown.
Mutual fund major Franklin Templeton shutting the door on 6 debt fund schemes, claiming impact of post-COVID-19 drastic fall in liquidity. The fund house has stopped all transactions and will now dispose of all assets in discontinued schemes and distribute the realized value among unit holders. Actual dispersal will depend on size of the actual claim by the unit holder. In a communication to its investry, the firm said the move is aimed at preserving best interest of the unit holders and preserve value. The investors now stare at uncertain future of investment to the tune of rupees 30,000 crore as a result of hardest blow to the debt fund industry, which can spook the retail investors. Despite the company blaming liquid crunch and the virus outbreak, the crisis in all likelihood was in the making.
Going by the real economy numbers made by some of the international agencies, we are not expecting a major recovery in 3 to 4 quarters. So that would reflect on the mutual fund markets as well. So overall, I would say that this will continue for some more time.
All 6 stressed funds had seen defaults and written down exposure to troubled Vodafone, Idea and Yes Bank. The company now has its task cut out. It must vie for best possible value for the securities and explore early exit option after market recovery. But most importantly, insulate other funds from the contagion and keep customers in loop. Investors on their part need to be patient, as payment is expected after company liquidates the security and pays off borrowings. In the meanwhile, investors must not chase high returns on funds with debt exposure and pick only high-quality debt instruments.
One thing is certain, that the mutual funds which have the backing of a group or are part of a larger corporate group will have better liquidity and better support from their parent to withstand any liquidity pressure, even if it arises due to the redemption pressure.
Will market regulators, SEBI, crack the whip and identify the patient zero in this possible financial contagion? Bureau Report, India Today.
What should the Security and Exchange Board of India be doing? What should the Reserve Bank of India be doing to ensure that there is adequate liquidity in the debt market at a time when industrial activity is virtually frozen? And most importantly, what should retail investors who are watching this broadcast be doing? Joining us on this broadcast, A. Balasubramaniam, Managing Director and Chief Executive Officer of Aditya Birla Sun Life, Saurabh Nanavati, Vice Chairperson of the Association of Mutual Funds of India, Chief Executive Officer of Invesco Asset Management, Rahul Goyal runs Equity Master, and Dhirendra Kumar is the founder and Chief Executive of Value Research. I want to start by asking Dhirendra Kumar about the kind of impact this will have on retail investors, because remember, most retail investors typically invest in hybrid schemes. They're not likely to have invested in the kind of schemes that Franklin Templeton has now locked down, but there's a lot of concern, and you would have received some of those queries, Dhirendra. What are the kind of queries you're receiving? What are the kind of concerns investors have? And what is it that you're telling them? What should investors be doing given this current crisis?
Of course, the investors are really worried. They are in a state of shock. These funds, unlike other debt funds, these funds actually have, large retail investor base. This fund actually has 310,000 investors. And so our general understanding that fixed income funds, mostly in institutional investors or companies invest, not really true. Good returns, and understandably, fixed income return has been on a decline, and investors have been looking for relatively safer fixed income avenues which can yield high return. And this was fulfilling that need. They are in a state of shock. At the same time, they are unable to reconcile. And even the long-term investor in such fixed income fund, they feel constrained that they can't take their money out at will. That is a compromise. I was taking a stock of the portfolio, and looking at the largest of the six, the Franklin India Ultra Short-Term Bond Fund. Investors will get nearly about 20% of the money. If the Vodafone Idea thing resolves and that is due for maturity in June, it will be nearly 20%. Then another 20% comes by September end. So
now, Saurabh Nanavati, you've had an opportunity to have various discussions within the mutual fund industry at the level of the Association of the Mutual Funds of India. How are you looking at this crisis in the debt fund sector, and what's the message the industry is sending out to investors who would naturally be very rattled by what they've seen happen with just one fund house at this moment, with just 6 schemes at this moment, but they'd be worried about what this could mean going forward?
So look, I think this did come as a shock when it was announced on Thursday night. And I think at the industry level, we have been in touch with SEBI, RBI, in fact, since the second week of March when this lockdown started. I think the regulators have basically taken a lot of actions to improve the liquidity situation. Given the COVID crisis situation, SEBI has also allowed us leeway in a lot of operational aspects. Liquidity is there in the system. You literally have 4 lakh to 5 lakh crores going in reverse repo every day in the RBI window. So this did come as a shock. I think we'll have to deal with it. It's a one-off. It's an isolated incident. It's unfortunate that it has happened to one of our members, but we'll have to take it on from here. What I would like to assure is whatever data we are seeing, including our own funds, there is ample liquidity in all the categories, including the credit risk funds. We have been facing some redemptions. We saw some negative numbers in March, and a lot of it did come back in April. So this should be treated by investors as an isolated incident. Go back to your advisors, get your portfolios checked, and in most cases, you will find that you are in safe hands with the mutual fund industry.
No, so Rahul Goel, the industry is saying very clearly this is an isolated fund, this is an isolated incident. Your investments are largely safe, and remember, these were high risk debt instruments which investors would typically have known or hopefully have known before they went into. But as Dhirendra Kumar said, that you're seeing over a period of years the same fund house, the same manager deliver high returns, and therefore you're likely to be drawn towards it. Now there'd be people who'd be concerned what could happen next. At Equity Master, what's the kind of advice that you're giving out to investors?
So, Rahul, the discussion you're having is, of course, very critical. And I think it's imperative that it be looked at from multiple angles. So if you look at it from the angle of the industry, of course, there has to be an effort to, address this as quickly as possible. But it's also a fact, to the best of my knowledge, this is not the first time it's happened. It's happened before, and I think this is repetitive. And I think the question that needs to be asked is that at the end of the day, who takes the hit? Now, I know I think you alluded to it. You seem to imply that in the beginning that it's not really the retail investors who want this scheme, but the larger ones. And Dhirendra, gave this amazing number of 310,000 investors. And I would ask Dhirendra this question: if you went out and interviewed these 310,000 people, I'm telling you that 99% of them would not have understood they're taking a credit risk when they're investing in a debt fund. They were investing in a debt fund. They wanted a higher yield. And whether the communication, the education that went down the channel did its job or not, that's open to debate. But I think that's the big vacuum over here. And if you think from the investor perspective, and I think this is the perfect moment to go back to Charlie Munger, who said that you should aim to get the highest return for the amount of risk you can take. You should not take more risk to get a higher return. And like how Munger speaks, he says that's inherently stupid. And I guess the people who willingly took the higher risk for the higher return, they have no one to blame. But the people who did not understand they were taking a higher risk and ended up in this situation, I think they're going to take a big knock. And we really need to ask ourselves,
what do you make of this? Because Frankel Templeton's high-profile chief investment officer, Santosh Kamath, was known as a pioneer in this investment style of betting on low-rated papers in India. These are corporate bonds which don't have a AAA rating. Would it be fair to say that most people had no idea? They just saw this as a debt instrument, saw it deliver higher returns, and therefore went in and blindly invested, and now have been completely blindsided by these events?
No, in fact, it is never one thing which is driving this crisis. There are multiple things. Multiple things meaning, first, we actually had our homegrown debt crisis. If you look at what happened since September 2019, first we had the ILFS, which came as a surprise. Then we had the DHFL. Then we had the Yes Bank. Then we had real concerns about NBFCs. And many of these fund companies took a hit. There was by the regulators, it was enabled that fund companies can segregate a part of their portfolio. These 6 funds, which have been, they have, if you look at the announcement, 3 of these segregated funds had 3 segregations in their portfolio. So you had the Vodafone idea. You have multiple things coming from different directions. So when you have bad times, things surface in different fashion, but it is reflection of the same thing. So the underlying, the fixed income crisis was largely contained because mutual funds money is not substantially into credit, corporate credit. It is somewhere else, and that is not unsafe. But fundamental design of a mutual fund is that funds invest in securities which may not be liquid, and investors have access to daily liquidity of infinite kinds. In that sense, I would say that these funds have reasonably succeeded. They are created for normal times when there is some little larger outflows or substantial inflows. That is fine. But when you have perpetual substantial outflows, they get stuck, and there was reason to be. If these funds, three of these funds had three segregations of portfolio, the money which gets blocked. The largest fund had 7% of markdown because of that segregation a few months back. So if investors, it's very understandable that investors panic. They say that whatever is left, let me take my money out. I'm not in for. Investors are not running out at the first instance or the first. They are not seeing the smoke and running away. They have experienced the loss. They have taken the hit, and now they are running away. And the real problem is that the fund, the leftover
Mr.
fund.
Balasubramanian, one of the things that we saw when the market tanked very sharply was that retail investors with systematic investment plans had shown a lot of patience and calm. They'd seen previous market cycles, and they figured if they just held tight with their seatbelt on, they'd be able to ride out this crisis. Given what's happened in Franklin Templeton Mutual Fund, do you believe that there'll be an increased pressure on redemption, not just with the instruments run by Franklin Templeton, but also those run by other fund houses? And how do you hope to counter this?
Yeah, I think clearly, I think as the other speakers mentioned about, this is of course one-off incident that has happened that made Templeton Mutual Fund actually shut the redemptions. Having said that, I think one has to look at the entire mutual fund industries, the way each of the portfolios have been constructed. I think we did an aggregate number for the whole industry, which manages about 15 lakh crore. Almost in the, other than credit funds, if I have to knock the top, which is roughly about 40,000 crores and overall 15 lakh crore. Rest of the money is, of course, invested in AAA securities and AA plus securities and government bonds and treasury bills. I think if you look at the overall portfolio constructions, right from liquid fund to go all the way up to the corporate bond fund and banking PSU funds, the portfolio quality is pretty good. And that's something which I've been highlighting for everyone, that I think the portfolio is reasonably well constructed with the high quality papers, and they are liquidatable. And those companies to whom we have invested money, they are the larger borrowers from the banking systems. Their ability to refinance is also equally high. But for the current situation, despite the liquidity being so good in the RBI systems, and where the people are going and giving money to Reserve Bank of India at 3.75% without lending in the money in the market, which is nothing but a risk aversion that they have built. But for that, I think there has been a good liquidity that has been there. But in the case of Franklin Templeton, I think I should also understand, as Dendra also mentioned, that when they have multiple accidents and the portfolio have been constructed only on the basis of the capability that he has invested in low-rated papers, and when such low-rated papers in these kind of scenarios lacks the liquidity in the market, naturally when they are faced with a lot of redemptions, even the good quality papers may find it difficult to get sold. Therefore, they have to, of course, shut the redemptions. That doesn't mean actually that all mutual funds will have a similar problem.
This is where the opposition is using this opportunity to raise the silence of the government. Former Finance Minister P. Chidambaram gave the example of what happened in 2008 to say that this is a matter of grave concern to investors. I recall a similar situation arose in the first week of October 2008 during the global financial crisis when mutual funds faced liquidity stress. Government immediately consulted with the RBI, SEBI, AMFI. An urgent meeting was held. On the next day, officers of RBI, SEBI met at 8 a.m. RBI announced a 14-day special repo rate facility and allowed for additional money to be drawn by mutual funds to help tide over the crisis. Now, what should the government really be doing in this situation? Our National Affairs Editor Rahul Srivastava spoke to Subhash Chandra Garg, former Secretary of the Department of Economic Affairs. Let's listen to what Subhash Garg had to say.
What happened in Franklin Templeton actually is part of a larger credit crisis. Indian businesses have credit of about 100 lakh crores from the banking system, from the NBFCs, and from various other institutions like the mutual funds, the debt fund, which Franklin was also running, was one of them. And this crisis is because the real economy is affected thanks to the lockdown and the COVID-19 crisis. This has led to a lot of businesses being not in a position to service their loans. The government has decided to provide moratorium. The insolvency code has been suspended. So a lot of measures have been taken, but the net effect of all this is that there is now much less information about the credit quality. The credit worthiness of the borrowers is suspect. This has resulted into lenders being not sure about the credit quality, and the investors into the.
So remember, the Reserve Bank of India has done bailouts in 2008 and 2013 when it averted a crisis in the debt market by creating a special window. The banks lent to debt funds and passed on assets as collaterals. The Reserve Bank of India accepted those assets as collaterals from the bank and lent money which they rolled back into the debt fund. So that's the kind of effort that's been made in the past. I want to start by asking Dhirendra Kumar first. What should the government, the RBI and other regulators be doing given the situation at hand right now, Dhirendra?
Everybody's putting a bold face that this is not a crisis. Everybody has the preparedness. They have done that. But this is actually it is not a crisis of credit or anything, but it is a crisis of, I would say, it's a crisis of belief. If a lot of investors start believing that it is not worth it, the risk that they have assumed, or there is a potential risk that they have assumed, and if they turn up, that itself can perpetuate. So one has to restore belief. So I think RBI just needs to provide a large amount of money, something like 10,000-20,000 crore, which will be allocated to buying bonds on demand, so that there is a real liquidity. Whatever be the valuation, why people don't panic in equity market? Because it's always open. There is a market at some price. Here there is a binary situation. There is a market or there is no market. You can't sell it at any price something. And that creates a kind of situation. And that is how it is designed. It is designed for normal times, not for extraordinary times. And this is so crucial. Tomorrow businesses will open. They have put money in these bond funds, which might be required for paying the salaries. And when they have little distrust that it may not be available, they will pull out. Ask any businessman who has put his money in a bond fund, which typically he would have.
And the problem in the markets is fear and negativity are self-fulfilling prophecies. As more and more investors get spooked out, if they start investing, that can be a vicious cycle. How do we avoid that? Rahul Goel, what are the kind of interventions you'd like to see from the RBI, from the government, possibly from SEBI, so that investors are assuaged and their nerves are not rattled?
No, I would, Rahul, I would flip the question back to you. Why should there be a bailout? And who are we bailing out? Are we bailing out the small guy who deserves the bailout? Or are we bailing out these big institutions? And I don't know. I think you should be asking this question. Are we saying the crisis caused the crisis? Are we saying the industry wasn't prepared for a crisis? They never built portfolios for tough times? They assumed everything will be great all the while? So again, I go back to the same point which I'm trying to make. The investors need to go back, look at their portfolios, and see what was promised and what they're being delivered. Second, they need to check whether they're taking on more risk than what they thought they were. And when it comes to a bailout, I'm sorry, I'm on the other side. I don't think big institutions need a bailout. All these big institutions should have planned. They should have had buffers. They should have had liquidity. And I heard a point about that the treasury market is illiquid. Well, I'm sure it's going to get liquid if you lower the price. So take the hit. Why should you be bailed out? This is like a
Saurabh Nanavati, you've been in touch with several officials in the Ministry of Finance. Are you seeing adequate response from them? What would you like to see government and regulators do? And do you believe that they're stepping in the way that's required? Rahul Goel questioning the need for any form of help, any form of bailout, saying that this is the risk the market takes. You sink and you swim with the tide.
Look, these are unprecedented times, right? We are in a black swan event. It's an event which will happen once in a century, perhaps. You go back and look at the US markets, where what happened in 2008 and when the Fed bailed them out. I think at this point of time, in the month of March, the kind of intervention that which they have done, where they have gone basically to issuers directly and lend them money. They have gone to financial institutions and have bought bonds from them. It's an unlimited quantitative easing which is going on across the globe. Uh, so the regulators are there to ensure stability in the market when these kind of disruptions happen. And I think that's exactly what we are seeking at this point of time from RBI and SEBI and the government, that there is a short-term disruption in the liquidity in the market, where for anything which is below AAA rated, perhaps it's just become a bit more difficult than usual times to sell, and kindly provide us with that liquidity at this point of time. Because even when we are talking of these AA companies, these are all the top companies. If you look at Franklin Templeton portfolio, they are all good operating companies in most of the cases. It's more a liquidity issue at this point of time. And that's what we want the government and the RBI to step
Well,
in
that's
and
not
provide
entirely
us that
correct, because
vote of
some of the
confidence.
investment is in Reliance, some of the investment
That's
is in
correct.
DHFL, and some of
It's
that
got
has
nothing
been
to do with
known to
COVID.
be building up. So obviously the decisions
it's
taken by, but the problems were building up. It's
All
also
those have been
the kind of
written off,
investments
right?
the fund
All
manager
those-
made, and now you're
Rahul,
having
can
to
I
deal
come in?
with.
Rahul, can I come in? So, COVID has very little role to play in this
Okay,
crisis.
very
It is
quickly, I'm out
created
of
by
time
the industry.
completely.
I have just one point to make. Are we saying the honest taxpayer in this country should bail out the big funds? Think about
Not
that.
at all. It is not. It is ensuring
I just want to
liquidity.
make one point in this.
That's a very wrong example.
Market can
That's
actually,
a very wrong example.
get suffer as a resulting of this disruption if a lot of people
Okay,
do this.
Dhirendra Kumar, I'll
like
give you
in the
30
US.
seconds. What do you make of this debate? Dhirendra Kumar, 30 seconds in conclusion. Final words, Dhirendra.
We need to really restore confidence in the market, and just enabling a mechanism. In 2008, we have done it just by virtue of enabling the credit to these things. The credit was never availed. It is not a bailout. It is enabling liquidity at a price. You remember UTI crisis? It turned out to be the biggest bonanza, a bailout which turned out to be the biggest bonanza for the government. That was one of the biggest disruption and the first lock-in.
Okay, so I'll leave it over there. You've heard different perspectives. It's a very tricky situation for investors to be in. But I think the key message going out from the experts is, if you panic and redeem right now, you're likely to be worse off than if you just have patience and allow for the markets to recover. It's all a cycle if you look back on a longer time scale. But will people have that patience to sit back and allow for developments to play themselves out? Or will they react in haste and then repent later? We will see what happens. For the time being, Saurabh Nanavati, A. Balasubramaniam, Dhirendra Kumar and Rahul Goyal for playing the devil's advocate and for joining me on this broadcast. Thank you very much. We'll track very closely what happens next when the markets open. Bye-bye.